Okay, welcome back to Chapter 10. In this chapter, we're going to discuss liabilities. Mostly current liabilities, a couple notes and contingencies. Liabilities. As you know, a liability is any time the company owes money to someone else for any reason. Okay, a liability is something that you owe to someone else for whatever reason. That's a liability. Okay, when a company or a bank advances a credit, it's making a loan. Anytime you make a loan to someone, we call it an advance credit. Okay. Company or a bank is the creditor. A creditor is also known as a lender. The person borrowing the money is called a debtor, and that could be either an individual or a company, or both. Debt is recorded as a liability by the debtor. Okay. So if you owe someone money, you personally have a liability, and that liability is debt. And we record that debt as a liability. There are long-term liabilities and short-term liabilities. Long-term is it's due over 1 year. Like, for example, a student loan. I owe student loans until I die. So that is long-term, right? Current liabilities are things that I owe in the short term, like a credit card. Credit card debt is a short-term or current liability. Other current liabilities include things like accounts payable, payroll liabilities, taxes. These are short-term, less than 1 year. Accounts payable, as you know, is the result of a transaction that has taken place for the sale of a good or service, and you have not yet been paid for it. So therefore you can, or you have not yet paid for it, therefore you create an accounts payable. You have received a good or service but have not yet paid, as accounts payable. Accrued liabilities is a reflection to pay its current or assets in the future. Accrued liabilities are normally recorded at the end of an accounting period as part of an adjustment process. Most companies, accounts payable and accrued liabilities are the largest portion of current liabilities. Notes may also be issued to purchase merchandise or assets. These notes are issued by creditors to satisfy accounts payables that were created earlier. We talked about this in earlier chapters. To illustrate or assume that, here's an example. This company issued a 90-day 12% note for $1,000 on August 1st for an overdue account that was owed to the company. So we debit accounts payable to reduce the accounts payable, and we increase our notes payable to increase notes payable. Basically, all this is we're transferring the debt that our customer owes us from accounts payable to notes payable, because it's going to be a little bit longer term. 90 days, 12%. So when the note matures, in other words, when the loan is due, the payment of $1,000 plus $30 interest. Why $30? Because we said that the interest on the note is 12% and it's for 90 days. So we take the 12% times the 90 days. The 90 days is divided by 360. Reason why 360 is because there are only 360 days in a banking year. There are 5 bank holidays throughout the year. That's why it's 360 and not 365. So we debit notes payable $1,000 to reduce that notes payable account. We debit interest expense, increase the expense that we've earned. And we credit or interest expense that we earn. We credit cash, $1,030. This is the reflection of when the customer pays it to us. A company may also borrow money from a bank to issue a note. On September 19th, the company borrowed cash from the bank by issuing a $4,000 90-day 15% note to the bank. We debit our cash $4,000 to increase our cash. We credit our notes payable to increase our notes payable by $4,000 to represent a 90-day 15% note payable. Then, of course, we're going to pay that loan back to the bank plus interest. We're going to debit the principal balance, notes payable, $4,000. We're going to debit interest expense, $150. The $150 came from the interest over those 90 days. $4,000 times 15% times the 90 days divided by 360 days to get $150. And we credit our cash to reduce our cash by $4,150 to represent the principal plus the interest that we paid for the loan. Remember, short term, less than a year. Long term, longer than 1 year. In some cases, a discounted note may be issued rather than a interest-bearing note. A discounted note has the following characteristics. It has the interest rate is called a discount rate. The amount of interest on the note is called a discount. It's computed by multiplying the discount rate times the face value of the note. The borrower receives, or the debtor, receives the face value minus the discount. And the debtor must repay the face amount of the note that's due. Okay, here's how it looks. So let's assume that our company issues a loan, a discounted loan to the bank. Here's how it looks. We debit our cash to increase our cash. We debit our interest expense, and we credit our notes payable. What this represents is a discounted note payable. We're only the original loan was for $20,000 over 90 days. Discounted. The discount rate is 15%. To figure out what the interest expense will be, we take $20,000 times 15% times 90 days divided by 360 to get $750. And we enter it like this. We debit our cash by $9,250. Reason why $9,250 is because the 15% interest rate for 90 days. So we receive $9,250. We debit our interest expense to increase interest expense by $750. And we credit our notes payable by $20,000. We still owe the bank the $20,000, although we only got $19,250. The difference here is how the interest is recognized. If it's a discounted note, we expense out the interest. That's why we call it a discount. Instead of us paying the $20,000 plus interest, we're only going to receive the cash that's less than the interest rate. We're still paying back the $20,000 that we borrowed. The difference here is that instead of the bank asking plus interest, they're just giving us less than that original face value amount. That's why they call it discount. And of course, when we pay the bank back, we debit notes payable to reduce our notes payable amount, and we credit our cash to reduce our cash. Does it make sense? Yes?
I have a question,
Yes,
Professor.
go ahead, Cornelia.
Um, in the quiz, we take the last chapter 10.
Uh-huh.
Um, Here says we had to. Let me read that. Hold on.
Sure.
Oh, okay. It says on, and that's a question. So on January 1st, Chicken Company obtained a 125,007 yards 5% installment note from Farmers Bank. The note requires annual payment of 20,602, with the first payment occurring on the last day of the fiscal year. So, and then they said the first payment consists of 6,250 interest and pay principal repayment of 50,352. But and then says journalize the following entries. I get lost over there because I get confused.
Got it. Got it. Uh, can
That's
you
a
do me a favor, Cornelia?
normal.
Can you
Uh-huh.
can you send me an email on it? I think I'll be able to better address the question that way.
Yeah, because it pay the it's like a note. It's a pay the first annual payment on the note. It's like
The first
I
annual
tell
payment
you,
on the note. Okay,
yeah.
and this one has a discount rate.
It's not. I'm not sure because that's why I get confused. I looking for the books how they work. It's like it's weird because I didn't find how to do that.
Got it.
That they use copy the question, journalize the following entries. So I will copy that problem and will email to you.
Yeah, please do. Yep, because that'll help me to address it.
Yeah, because I trying to do, but it like get me crazy.
Got you. Yeah, no problem.
Yeah,
Yeah,
perfectly.
I'll help you out.
Yeah, please.
Okay. All right. Thank you.
Okay, that's installment note. That's the one they have in the question.
Yeah. Yeah. Just go ahead and send that email for that one. I'll take care of it.
Okay.
Thank you. Okay. Uh, okay. So let's talk about another very and Cornelia, this will actually probably help to answer your question as well. Is let's talk about the current portion of the long-term debt. The current portion of long-term debt represents the amount that is owed within the next 12 months. That's why we call it current. Think of a loan. Let's say you have a loan for your house, okay?
Okay.
It's a 30-year loan, 30-year mortgage, 30-year loan. And let's say that you moved into the house and you started paying on the loan. The next 12 months of that 30-year loan, we call that next 12 months the current portion of the long-term debt.
Oh, okay. Understand
Does
that.
that make sense?
Yes.
Okay. It's, just work with me because I think it'll help. So the current portion of long-term debt is reported on the balance sheet as a current liability. An investment note is a debt that requires a borrower to make equal periodic payments to the lender for the term of the loan. Installment note is the same as saying a mortgage. You pay the same amount on the mortgage every single month until for the life of the loan, right?
Yes.
The installment notes are often used to purchase things like property, plant, and equipment. So that's current portion of long-term debt. In your question, it's similar because you have the current portion of that long-term debt. Within that current portion, you need to calculate the discount rate. So you take the face value for that 12 months. You multiply that by the discount rate, but within that calculation, you want to take that discount term and divide that by 360.
Okay.
And that should help. But we'll talk about a little bit more when you email it to me, because I think you're on the right path, is what it sounds like. Okay. Next thing I want to talk about is payroll. Payroll, as you know, is what's being paid to your employees for them working. That's payroll, right? Hopefully, we all get paid for our work, right? That's the idea.
Yeah.
We receive a payroll check. So the company reports payroll for to pay its employees. Within payroll, your employer has to pay payroll taxes. Okay, you pay taxes, and your employer pays taxes. You pay Social Security. Your employer pays Social Security, unemployment, and a couple of other taxes. And then you pay your federal taxes, your state income taxes, and any other taxes, right? So both you and your employer are required to pay the same taxes. The difference is that your employer also pays an unemployment tax. So let's talk a little bit more about wages. Salary is something that is usually a fixed amount over a year or over a month, and the employee receives that same amount every single month. Wages refer to hourly employees that work, on an hourly basis, and they get paid on an hourly basis. And of course, sometimes there's bonuses, stuff, fancy stuff like that. And of course, employment must follow the Fair Labor Standards Act, also known as that includes federal minimum wage and hour laws. This require that for every hour an employee works over 40 hours, they earn what's called time and a half, also known as overtime pay.
Okay.
An example of that, I have an employee that earns $34 an hour. The employee worked the initial 40 hours. 40 hours times $34 an hour. The regular rate is $1,360. That same employee worked overtime by 2 hours. $34 an hour times time and a half, or 1.5. 34 times 1.5 times the 2 hours that the employee worked overtime gets me to $102 for overtime pay. The total earnings for that employee's week is $1,462. I got that by adding together the regular rate plus the overtime rate. There are other deductions from employees' earnings. You have what's called gross pay. Those are all of your earnings before any deductions or taxes. And then you have net pay. Net pay is what you actually get in your paycheck. That's the amount that actually gets deposited to your bank account, is the net pay. Gross pay is before any deductions and any taxes. Net pay is after all of the deductions and taxes. Deductions for tax include things like federal state and local taxes, medical insurance, pensions, life insurance, any other types of contributions that you make. Employers normally withhold a portion of employees' earnings for future payment of federal income taxes. Employees authorize this amount by completing the W-4. Every employer in the United States requires you to complete a W-4. W-4 indicates your marital status, withholding allowances, if you're single, married, divorced, any of the head of household, all that good stuff. Also records any federal income taxes withheld. On the employer side, your employer, they have to pay what we call FICA. This is the Federal Insurance Contributions Act. This includes Social Security and Medicare. Both of these two things your employer pays into for your well-being in the future. So that's what they say anyway. I don't know if that's true, but that's what they say. The amount withheld from an employee is based on the employee's earnings paid during a calendar year. And of course, tax rates and minimum earnings apply. So these are set by our fancy friends at Congress, who I really don't like. Social Security, this was, I think it was like 2 years ago. It's probably different now. The book was written in 2017. So Social Security, 6% on all earnings. Medicare, 1.5% on all earnings. I think those are slightly different. So this tells us how much the employer should be withholding for Social Security and Medicare. The employee earnings were $1,462 for that week. The Social Security is 6% rate, $1,462 times 6%. The employer needs to withhold $87.72 for Social Security. Then, of course, the employer must also withhold the Medicare tax. Medicare, we take the gross earnings, $1,462 for that week, multiply it by 1.5% to get to $21.93. The total withholdings for Social Security and Medicare is $109.65. Other deductions that might come out of your paycheck include things like retirement, that's 401k, IRA, 403, 401, you name it. There's a whole bunch of numbers, right? Retirement. Then you have charitable contributions and life insurance. These are other common deductions. Gross earnings minus payroll deductions equals net pay, also known as take-home pay. Going back to our example, our employee makes 20 bucks, or our employee's gross earnings for that week is $1,462 minus all of these great deductions. Social Security, Medicare, federal income, retirement savings, and a donation to get to net pay, $1,069.40. We take our gross pay minus all of our deductions to get to net pay. Okay, on the employer side, we have the FICA tax. This includes federal unemployment compensation tax and state unemployment compensation tax. In the event that you ever become unemployed, the reason why you're able to receive unemployment benefits is because of the work that you put in. You work, you get unemployed, you're eligible for unemployment. Unemployment comes from the amount of time and earnings that your employers have put into the program. Payroll liabilities are only recorded at the end of the payroll period. And this is what that looks like. Salaries, office salaries, total payroll, $25,000. Total Social Security, total unemployment, all that good stuff, right? That's just an example of what it looks like. So all of the salaries for that month, all of the Social Security, Medicare, income tax for federal and state, retirement, blah, 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 all of that totaled up for the month. Employers must match the employee's Social Security and Medicare taxes. For every dollar that you, the employee, pays into Social Security and Medicare, your employer must match. And in addition to that, your employer also pays into federal and state unemployment. So that's the real primary difference between the employer and the employee, is that the employer also pays unemployment. The employee does not pay into unemployment. Okay. Paying payroll, companies need to transmit payroll through payroll checks. In today's day and age, we use electronic funds transfer. The money is automatically deposited into your bank account through this process. It's not as common these days for physical checks to be sent in the mail because of, we're in the 21st century. Everyone's doing banking online these days. Most companies use special payroll bank accounts for payroll only. It's really important that employers separate payroll bank account from their regular bank account. This is because we don't want things to get all muddied up, especially when it comes to taxes. There are internal controls for payroll, such as the hiring and firing and promoting and demoting processes that are set by your HR company, by HR within your company. Employees need to observe these types of things. There's a process by which you punch the clock, as they say. You check in, you check out, using your ID card, things like that. Those are all internal control processes to make sure that you're actually working the hours that you say you worked, right? You punch a time card, you clock in, you clock out, that type of stuff. If your salary is a little bit different, but your hours are still typically tracked. Fringe benefits. Sometimes companies might offer benefits such as vacation, medical, dental, retirement that the employer pays. Well, that's nice. That's nice when that happens. It's at a cost. The cost of the employee is the fringe benefits by the employer. Vacation pay. Vacation pay is accrued for over each pay period and is recorded through adjusting entries. At the end of the year, the company accrued vacation pay expense of $325,000. We debit vacation pay expense and credit vacation pay payable, $325,000. And as you know, just like any other payable to your employees, you debit the expense to increase the expense, and you credit your payable to increase your payable. It's the same concept. If employees are required to take vacation within a year, it's paid out through that process. Okay, pensions. Pensions are for retired persons of the company. Pensions are they're kind of going away, so it's not like they're not as common as they used to be. If you get employed by a company that still has a pension, good for you. Hopefully you'll get it. Pension rights are accrued by the employee as they work based off of the pension plan. There's two types. There's defined and contribution. A defined contribution plan is where the company invests contributions on the employee's behalf. And then there's usually an option for the employee to invest as well through the 401k plan. In most cases, employers will match up to a certain percentage. This is debited to the pension expense. When an employer matches to a retirement fund like a pension, we debit pension expense by that amount and we credit cash by that amount. There's also a defined benefit plan. This is a fixed annual compensation based on a formula. The formula is based off of number of years of service that you've worked for the company and the age of the employee and the amounts of past salary. I'm just kind of flying through these because they're not as relevant. I mean, they're important, but they're not as relevant. Employees may earn rights to other benefits such as daycare, eye care, medical, life insurance, tuition assistance, tax services, legal services. Those are all expenses to the employer if the employer offers those benefits to you. Call those and there's also post-retirement benefit expenses. Okay, installment notes. We talked a little bit about this in the last chapter. Installment note is a debt required that the borrower makes equal payments back to the lender. Those regular installments are called a principal. There's usually an interest amount that's included. Principal plus interest is the payment amount. Principal gets allocated to the principal balance. Interest is allocated as an expense. And installment amounts are usually set to purchase a specified asset. Okay, talked a lot about this in the last chapter. It's kind of repeated. When an installment note is issued, we debit cash and credit notes payable. Again, very, very similar to what we learned about in the last chapter. In fact, it's pretty much the same. Periodic payments, instead of making regularly scheduled monthly payments, periodic payments might be done at different intervals, and it's usually measured by the number of intervals. Okay, contingent liabilities. Contingent liabilities is the potential for obligations. And this is based off of the likelihood of something occurring and based off of its measurement. Likelihood of something occurring. It's like saying, well, my house might burn down, but the chances of it happening are relatively low. That's how, like, insurance companies calculate how much the premium is. What's the likelihood of something happening? Probable versus estimable. Probable. The probability of my house burning down as a result of fire is very low. It's probably around 10%. Therefore, I will estimate 10% of my liability expense through my insurance. It's a way of estimating things, right? And just like with warranties, let's say I'm Samsung, I expect a certain percentage, about 5% of all of my sales, to utilize the warranty. And so therefore, I will estimate $5,000 of my total sales through the warranty, things like that. I estimated the 5% of my sales will go through the warranty process. And you can estimate things like and we learned about this in the previous chapter, is when we estimate a percentage that we will not be paid back, right? Okay, real quick, a couple ratios that are important. Working capital. When you hear the word working capital, it's the amount of cash that the company has to work with, right, in order to continue to operate. To calculate this, we take our current assets and we subtract our current liabilities. That's the current working capital ratio. The current ratio is another ratio that's used to compute the company's ability to repay its debts. We take our current assets divided by our current liabilities. That ratio tells me the company's ability to repay its debts, its short-term debts. There's also another one called a quick ratio. Quick ratio is a limitation by measuring the company's ability to repay a portion of its debts. We take quick assets divided by current liabilities. Quick assets are things like cash and other things that will be quickly converted to cash, like inventory and accounts receivable. Okay, and that, my friends, is the end of Chapter 10. It went a lot faster than I expected. Are there any comments, questions, or concerns I can help you with before we call it a day? We're good?
Yeah, we're good.
Okay.
Okay, I appreciate you all hanging on. I know we went over time. I apologize for that. I didn't expect that Chapter 9 was going to be that long, but it was. So,
Yeah. Professor,
yes, Cornelia.
I don't know if it's, I would like to suggest, when you post a quiz or whatever, a quiz, a homework doesn't matter because I try to resolve as the way I can, right?
Yeah.
But the when you post the quiz, like could you because you post more of the match, and I really get it wrong over there because I try to how do you say, find the right answer
Uh-huh.
for a match,
Yeah.
but it's hard because I read my books. I find page by page. I check over if where I can find the answer should be there, right?
Yes.
But it's like oh, guys, it's like get me like so frustrated because it's
Yeah.
hard to find sometimes the answers on that book.
Yeah, the matching questions are probably the hardest ones.
Yes.
Definitely, I agree with that. So what I've agreed to do is I will allow for partial credit on the matching questions. So the parts that you get right, you'll get credit for. The parts you get wrong, you will not.
Because if I get something, some questions right, they how do you say the grade like a wrong everything.
Exactly. Yeah. Yeah. I'll fix
So
that.
that's
Yeah.
why I don't like it because you know, when I read a book, I say that's the answer for this specific. And
Yeah,
then
I know.
if I get if I get 2 or 3 wrongs from match, and then my like it's wrong everything for them.
Exactly. Yep. Yeah. I'll fix
So
that.
does that apply to the midterm too, or that's just only
Yep.
for the quizzes?
No, I'm gonna apply it to everything. So I'll go back and make corrections to the grading to ensure that if you got part of the the matching part right, I'll make sure that you get credit for it, and that'll be for everything that's already happened and everything that will happen.
Oh, okay. Because please, could you fix that part? Because honestly, I feel so bad when I say
I know. I
I
know.
read my book because I check the answer is the right way. I get sounded. I
I hear
say
you.
like most of the homework I submit is like the matches most of the time.
No problem. I'll fix it.
Please fix that part because honestly, I feel so mad when I get it wrong everything. Oh God.
I understand.
Yes, only the mistake. That's only the suggestion I make because
Sure.
now from the other part it's okay.
No problem. I'll make it right.
Okay, Professor. Thank you.
Well, thank you everyone so much.
Professor, one more question.
Yeah.
Could,
Who's that, Professor?
can you give? Oh, okay. Who's asking? Go first. Somebody ask?
Go ahead, Cornelia.
Oh, okay. Can we retake the quiz note?
Quizzes can be redone up to 2 times.
Yeah.
But
So
not the midterm. The midterm can only be done once.
oh, okay. Yes, once. Oh, okay. I got it. Thank you.
Okay, you're welcome. Okay, any other comments, questions, or concerns before I stop the recording? Okay, hearing or seeing no other comments, questions, or concerns, I hope you all enjoy the rest of your day. Thank you so much for sticking it out with me. Appreciate it.
You too, Professor.
Thank you.